The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, boys and girls. This is Larry Pesavento for TFNN, and today's going to be story time day. First of all, try to look at the charts that we post into Tiger TV today, because I think these are very important where we are in the markets right now on a worldwide basis, and especially the U.S., but we are at a very critical time. And I started out by showing you that the Bradley model is still heading to the downside. The market is very, very oversold. We had Europe down about 2.5%. Asia was down. We were only down 1%, so we held up relatively well. And if like Basil said, if we could close good today, that would be an ideal situation. The best birthday present we could get would be a nice rally this week into the 18th to the 20th. The 20th is the new moon, and as you know, that the last time we had a new moon, it was a sell, and so if we come into that would be the same thing. I'm going to try to build a case, for what I think is going to happen between May and June. Whether it happens or not, I don't know, but the risk will be very, very small, and the profit potential, will be, really, really good. If we take a look at what's happening around the world, you can see that, most of the markets are down quite a bit. Spain and Italy are pretty much in a depression, based on, where their charts are. Spain's stock market is below where it was in 1995, and you can imagine, what's going on over there. We're having a lot of trouble in Russia. The rest of the world's not too bad. They're down, somewhere between 13 and 3%, but this could change quite a bit. We're at a very critical level in the euro at the 128 level. That equates to about the 81 level in the U.S. dollar index. So we have to keep a very close eye on that. And let me try to explain to you what happened. And I don't like to use the C word, the crash word, very often, but increased volatility, I can use that word pretty good. In 1987, I had a show on TFNN. That was the CNBC. Before it was CNBC in Los Angeles, and Bill Griffith was the host, and Bill had been a friend of mine, and so he and Ron Insana both, when Ron was just a college kid at USC, and they had me on the show once every 2 weeks. And in 1987, in August, August 25th was the harmonic convergence day, where we had 5 planets occurring in Leo on August 25th. That had never occurred before, all on the same day, and that was the top of the market at 2,700 in the Dow. And I told Bill, I said, sometime, during October, we're going to have a day where the Dow is down, more than 300 points. And the reason why I told him that, I said our biggest day in the Dow had been 190 points, and if you multiply that by the 1.618 expansion, increased volatility would take us down about 300 points. And of course, on October the 19th, 1987, the Dow was down 16%, and it was down, I believe it was down about 1,600 points, as I recall. Actually, the low was 1,660, but I believe it was down 16% in value. It had gone from 2,870 down to 1,660 in a matter of 6 weeks. And so I don't know if this is what's going to happen this time, but what I'm going to try to do is to build a case for what we're looking at here. And if we look at the fact that all the foreign markets are down, that's A. B, we have the Bradley model pointing down, and it's been quite accurate, over the last 6 or 7 months. Number 3, we have commodity markets totally falling apart. We've been talking about that for several weeks. The DBA gave up the ghost, several weeks ago. We talked about the importance of that gold at 1580. It gave it up, basically Friday. Silver gave it up today. And, these markets are all looking bad. The grain markets are reacting badly. Soybeans came off that triple top. Wheat is down. Corn is down. Rice is down. Everything is down. I mean, and all we need is a little margin call selling, and the hedge funds will be running to the woods. So we'll have to see how that unfolds. But it's all setting up that we're going to get some really creased in volatility, and it looks like the best time for this to occur is between the 18th and the 22nd of May. There's a little band in here. We have a pretty important date today and tomorrow. It's based on some geometric things with one of the cycles that we look at. And the ideal situation for us is, if we're bearish, is if we can move from the low today. In fact, the low today was actually pretty nice. Steve pointed out on his show that we made a beautiful A, B, C, D, 3 drive to a bottom pattern down near that 1332 level in the S&P. It held that level so far. The Dow just basically took out 2740. It's an outlier event. We're down 9 out of 10 days in the Dow, 9 out of 9 in the NASDAQ. We've completed A, B equals CD patterns all across the board, in all the indices. So all of these things are telling us, that we are due for a rally, and that would be, the ideal situation is if we can finally do that. Now, the things that we're watching as far as I'll post the for Tiger TV. I'll post the chart that Steve was looking at. That's the big ABCD going back from the 6th of May into today, and the price objective was down there around that 1332 to 1334 level, and that completes an ABCD. And it's been a very orderly market, folks. There's been no volatility in the U.S. stock market at all. I mean, it's just been very, very quiet, and that's what I'm expecting. I'm expecting this volatility to increase, a great deal. Now, it's set up that it could go to the downside, and what I'm looking for, of course, is, in fact, if it can bottom today, and the ideal situation is if we could get about a 40-point rally, several hundred points in the Dow, get the S&P up around that 13. I don't know where it'll be, maybe next Friday, but we'll see. 1370 maybe 1380 if it can get that high. And then what we look for is where the market comes down and takes out today's low. That's going to be the key, because if that's the spot, that's what we want to be looking at. Now, the scenario that we have that also, in fact, I'm going to do a special report for the newsletter folks about this, because I think it's important enough to really bring out all of these factors. They might not work. I don't really care if they work or not. I mean, because we're basically traders, but you don't see setups like this where everything is lined up, all together, all at the same time. And what I'm going to do now is, if you get a chance to go into Tiger TV, I'm going to post the relationship between where the current New York Stock Exchange Index is now, overlaid on the market from 1987. Now, it's not a perfect correlation, but the correlation is in the neighborhood of about 90%. Now, all markets, act a little bit differently. So the real key here is, I believe, rests in what's going to happen with the U.S. dollar and the euro. Because if the euro goes below 128, and the reason why I say that is the 786 retracement of the last move on the daily basis came in at 128.10, and the low today in the euro was at 128.09. And so if we can hold that level, we haven't rallied very much, but if we can hold that level, that could give us a little rally. But in 1987, the whole thing that occurred with the crash of 1987 started in the foreign exchange markets in Japan. Secretary of Treasury Baker, came out and said they were unable to reach an agreement, and all hell broke loose on Sunday night. We didn't have overnight markets in the S&P, but we did have them in the currencies. Forex, virtually nobody was trading Forex except very large accounts. But the Swiss franc moved like 250 pips. Gold moved like $30 to the upside, and these were the things that were occurring that made it really wild, and that's the real reason what we're looking at. So the main thing that we're watching is the correlation that we have here. Now, what I'm assuming is that because we had this AB equals CD, formation has completed. If we could get this little rally into the 18th to the 22nd, that would set up a perfect, situation for some increased volatility to the downside. I don't think there's any question in my mind, anyway, that we're not going to have the increased volatility. The question is, are we going to get the rally into that spot? So that's what we're going to be. That's what we're going to be watching extremely close. Now, when we get to the second half of the show, I want to talk a little bit, more than a little bit, about our all-time favorite is Treasury bonds, because we are very, very close in the TBT. We're only a few cents away now. I think we're about 40 cents away in the TBT of making spot. We want to talk about that on the second part of the show, because that's going to be the trade of the year. I think it'll be the trade of the decade. I don't know if it'll be correct or not, but we're going to have a pretty good idea of what's going to happen with it by the time we get to, when we get into this time frame between the 18th and the 22nd, which we are, very, very close. So this is the main reason why we're watching it so closely, because, we've been watching it closely all along, and, many people said, oh, it'll never get there. But, as we look at it now, we're getting very, very close, to that spot, and that's the real reason what we're looking at. So the main thing for the stock market is this is a really important low. If it does occur today, we have a chance for the market to have a pretty good rally. The U.S. dollar index, I stopped right at the 786 on the downside, right there at 78.80. We rallied a couple of points off that. We're up at 78.80 on the upside, and this is what we're looking at. The good things that I see about this particular stock market, sell-off that we've had is, the U.S. market has not. It's been very, very orderly. I mean, ordinarily with the European markets down, 2.5%, and Asia down, and the German bond making a 10-year. The yield on a 10-year bond is 1.4% in Germany, and it's 1.44% for the U.S. Treasury notes, and the 30-year bond is under 3% now. So these are the things that we're looking at. One other factor that's very important, at least from the the bullish side or the bearish side, whatever you want to look at it, and that is the fact that we want to be watching the Facebook, because it comes out on the 18th, and I talked about this on the show last Thursday. I wanted to bring it up again. I'll probably bring it up every day this week, because I think it's very important, and that is the fact that in 2007, when Blackstone, which is the largest private equity group, came out and let everybody buy into their firm at roughly $38 a share before it went to $4 a share. That's telling you that, when they let you in, you got to ask the question, why are they finally letting me in? Now, I saw something on the internet that 74% of the people thought that the Facebook IPO would be overpriced. Now, whether that's going to be affected in the market or not, I'm not sure. But when you have people like, Apple co-founder Steve Wozniak coming out and say he was going to buy Facebook at any price, just be careful what people say, because what they say is not necessarily what they mean. During 1929, when the market was crashing, J.P. Morgan came out and said there was no way that General Motors would ever trade under $50 a share, because he would buy all that was available. And believe me, it went from $50.10 a share to $48 without any trading. And he said, whoops, I forgot to tell you that I changed my mind. So we just remember, what people say is not necessarily what they mean. 877-927-6648.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back, folks. 877-927-6648 if you have any questions. And now we're going to move to our trade of the year, which is the Treasury bonds. We've been waiting on this since January, and January of this year, not January of 2011. We have a potential now that we're getting. I'm looking to see whether we move into new high ground in the Treasury bonds. We've made new high grounds in the Treasury notes. The short-term paper has definitely completed the equivalent of the 149 level in the Treasury bond market. Now remember, people are borrowing money. The government is borrowing money from you, of course, at an interest rate of less than 3% for a long-term, 30 years. I don't know anybody that would borrow any money or lend any money at that point. But we'll have to see what occurs. I don't know. I'm not actually sure. What a fair rate would be. But I know we've been going down in interest rates for 30 years. We've looked at that long-term pattern many times. That's a big butterfly pattern. We've had lower tops, lower bottoms. Higher tops, higher bottoms, all the way up. Interest rates have been dropping. And so this is what we're looking at. We're at such a key critical level this week because everything is telling us technically that we should be at a really good bottom in the market. The fact that the volatility has been very modest For the U.S., not so much in other countries, but especially in the U.S. We've had a nice rally in bonds, which we were expecting would be occurring. The euro's come down to the the 786 level, and we have a real chance here to see if this is going to be the case. And a lot of it is going to be based, on what happens with, Tom calls it the king dollar, and it certainly has been king, for the last 10 days. We've had a tremendous move up. We stopped exactly at the 786 at that 78.80 level 10 days ago, and now we're approaching the 786 again on the upside at around 8,100. We're trading at around 80.70 right now. So we're at a very important spot, with the U.S. dollar also. So all this is fitting together pretty nicely. And if we do get what I think is going to happen, this increased volatility, it's going to be based on when we take out, and if we take out, the low that we make either today or tomorrow. And that should be a very important low. And like I mentioned before, the ideal situation for us, if we're bearish, is to have a nice, quick, and the faster and the quicker and the more the better rally into the Facebook IPO or the new moon, of the 20th, whatever you want to do. I don't really know what's going to happen with the Facebook IPO. I know it's going to be heavily, no question about the fact that it's coming out. I haven't seen an IPO with this much hype behind it since Google. And if you remember, Google came out at around, I think around 85 to 100. I think it went to 100 and went to 120, pulled back to 70 within 2 days. That was the 786 of the opening of the IPO price. And from 70, it never looked back. It went to, well over. I don't know if it hit 700 a share, but it came pretty close to that. So this is a different type of market that we have now. We're more mature in the markets because we are in bear markets, folks. You have to remember that. Just look at the chart, second chart that I posted in the Tiger TV. It's all the world indices and what they're doing. And this bear market hasn't started. We've been talking about this for a long time, and now people are beginning to realize that maybe something's not right in Camelot. So we'll have to understand how the market's going to respond to this. But technically, this is a really critical week. I mentioned it several times, but between the 15th and the 22nd, we've got some real serious stuff that's occurring. And if you're bearish, ideally what you'd love to have is a really quick rally into the 22nd, and then from that point you'd be able to reverse and go short. And if it keeps going up after the 22nd, I'm probably going to be wrong, which I'm wrong quite a bit, but at least we'll know it. And if we do take a position, it's going to be very, very small. But if we do get up into the 18th and the market closes really badly on Friday the 18th. I'm not going to have a show that day, but I'll be talking about it on Thursday. But if the market closes really badly, especially if it closes below 12,700 in the Dow or 1332 in the S&P, that is when the door shuts. And that's when the proverbial fat lady begins to sing the opera. Anyway, we're going to take a little break here. If you have any questions, it's 877-927-6648. And we get back, we're going to take a little deeper look into the bonds.
You've heard Tom O'Brien on the air, and you've always thought about trying out his newsletter, Market Insights. Well, now is the perfect time. For a limited time only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System. If you decide to cancel within the 2-week trial period, pay absolutely nothing and keep Tom's book as a free gift from us. Tom sends out his daily newsletter each morning by 9:30 a.m. with trade recommendations options, including price targets and price stops. As recently as March 21st, Market Insight subscribers closed out a position for more than a 25% profit in just over 2 weeks. To get your 2-week free trial to Market Insights, along with your free copy of The Art of Timing the Trade, your ultimate trading mastery system, visit the front page of TFNN.com. Supplies are limited for this one-of-a-kind special, so act today and don't let this opportunity pass you by. Offer only valid for new subscribers. Has the current market volatility continued to stop you out of trades when temporary market spikes move against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the advantage of keeping your trades open even when the market temporarily spikes against you. Nadex's innovation has allowed them to come up with a line of unique short-term binary options that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and we're going to be talking about the Treasury bonds now. And we have, the long-term 30-year chart I posted into Tiger TV that shows the big butterfly pattern that occurred. If you'll notice, another one occurred in 2003. That one had well over $20,000 in profit, but I believe this one is the mother of all butterflies because it's been a 30-year pattern. It's been going on for a long time in interest rates, and it certainly looks like it's completing right now. We have a situation also now where we have short-term rates are making new lows in yield, whereas the 30-year bond has not taken out the lows. We're making a triple top up in here, but we have not taken it out. That makes me wonder whether we're going to make that 149 to 150 level in the T-bonds, and we certainly could if we get some increased volatility to the downside in the stock market. If we go below this 1332 level in the S&P and 12,700 in the Dow, I would assume we're going to get a lot more volatility. But getting back to the T-bonds, we're definitely going to be in the T-bonds by next Tuesday. Monday, well, we're going to see what happens on Monday. Because we got that new moon coming in on the 20th, which is Sunday, so we got the 21st, 22nd. So it's going to be, that's probably where we're going to enter. It would be on Tuesday, whether it makes our price at $17.80 in the bond or not. We'll have to wait and see. Trading the ETF. The bonds trade beautifully as far as, if you're a futures trader, it's very, very easy to put a 15-point stop in, which is $500. And, it acts, relatively well as far as able to keep the, loss protection right. Now, part of this that we talked about in the early part of the show, it's all fitting so closely together, to what happened, similar to 2007, that it's truly amazing. We've been looking at the potential for the break, in these commodities, and we're certainly getting that. I mean, the DBA triggered that, several months ago, when we talked about last week several times about the importance of 1580 in gold, and we went through that, Friday. That we got down to 1572. We actually closed, right at the 786, and then we started lower, on Sunday night. That tells us that we're going down. That just means if we get a rally, there's going to be strong resistance in the gold up around that 1580 to 1600. That would be, what I would be expecting to see if this is what should happen, on a technical basis. But everything is setting up. I mean, it's really got all the things that, and believe me, this is all technical, folks. It has nothing to do with fundamentals. I know, diddly squat about, what they're planning to do with elections or, any of this other stuff. It really means, virtually nothing to me. I'm just basically looking at the fundamentals of the technical part, not the fundamentals of what's in the market, but how the technical things, actually work. And, we're trying to put it all together so that you can see it. Now, I'm going to bring up the chart on the notes because I think it's very important to realize that, we've completed this huge ABCD in the notes. We've made new contract highs from last September. We took out the contract highs from January, and we've not been able to do that in the 30-year bond. And that means that we have a triple top in interest rates on the 30-year bond, whereas the notes, which are the 10 years or less, are actually making new interest rate lows. So this is a divergence that's, very important. And, that doesn't mean that the 30-year bond can't catch up if we get something really crazy happening. But, the market's going to tell us whether it's going to do it or not. And I believe that all we have to do now is wait until the 22nd of May, that's next Tuesday, to see if this is going to unfold the way we want it. We might have to pay a higher price, for the TBT to enter, but we'll know exactly where to put our stop. It will be below around $16 a share, would be my guess. But we'll have a very good idea, I believe, on Tuesday, and that will give us more. In fact, we'll have a better idea as we get to Wednesday and Thursday of what we think is happening, and then we'll watch it from that spot. But the notes have made new contract highs, and today's high was substantially more than the one we had last week. The Treasury bonds also went up and made a 1.618 expansion. Also, the same thing happened with the German bond. It made a 1.618 expansion. So we're in this zone here where everything is fitting together nicely, so we'll wait and see. Now, someone had a question, will I feel stupid if the market doesn't have this increased volatility to the downside? Folks, I feel stupid a lot. That don't mean I can't keep trading. I mean, trading has nothing to do with being smart. It has to do with doing the right thing at the right time. And all I'm trying to do is to put it together. And the one thing I don't want to do is to stand in front of a freight train if the market starts to explode to the upside here. So what I'm looking for is the market to come up today, make some type of a bottom if possible, rally into Friday, possibly Monday. It'll probably be, they use Facebook as the excuse. But I don't think that'll be the reason. But we'll have to analyze that as we come to it. But the real key day is there's one today, tomorrow, which is the 14th, 15th, and then we have one on the 20th to the 22nd. And because of the Facebook thing on the 18th, if the Facebook thing really flops and comes into the lower end of the range and closes really badly, much like what happened with the Blackstone, that would really tell us a lot. That would put another peg in the coffin for the bulls, because we have so many of them there. We want to repeat them again. The patterns that are occurring have all been bearish. The markets of the world are all going down. The commodities are collapsing. The euro has critical support at 128. Below that, it's goodbye. It'll be 125 to 117. The bonds have made new. Making recovery highs. Notes have made new all-time recovery highs, which is a flight to quality. And I believe that people that think that the bonds and notes are flight to quality is like the analogy of the fireman going into a burning building with a gasoline can trying to put it out. Because our paper is no different than Greece. The fact that we have a lot more assets, than they do, but our paper has also been downgraded, and that's a bad sign in itself. And we're spending $1.7 trillion more a year than we're taking in, and that eventually means that our paper is going to be worthless. What's having a problem now is the people that are inflationists, that always think that gold's going to go to 3,000 or something like that. Commodities are going down just like they were in 07. Look at crude oil, folks. We talked about the importance of $96 in crude oil. It went through there like it didn't even exist. We went, $2 a barrel, under that last night. So all of these things are starting to, roll over, and you have to pay attention to that. So the question is if this bottom is occurring, and we do get a nice little rally, what is it going to mean, into this Friday? And I'm only looking for a 4 to 5 day rally. That's all you're going to usually get in a really bear market, and the stronger the rally, the better. That's the main thing that you want to keep in the back of your mind, because that's what's going on. But the commodity prices have really told us that they want to go down. The world markets have told us that we want to go down. I'm just trying to alert you to just don't get too bullish in here, folks, because at any moment you could come in and they're going to turn the lights out or dim the lights on several different places, and these markets could have a really big acceleration. We've had very little volatility in stocks. It's people are pretty much complacent. There's been lack of interest more than anything else, but the question is what's going to happen this week, and I think it's a very important time to really come back and watch this, because we've had so much weakness coming across all of these markets that it's indicating that there's something not right in Camelot. And like I mentioned before many times, is if we could just get this little bit of a rally here this week, and in the matter of fact, if it's a very, very weak rally, and so let's say we only rally maybe up to 1365 or something like that in the S&P. Then that's telling us that we're ready for a really big market to the downside. Steve Rhodes on his show mentioned that he was looking for around 1150 in the price of gold, just looking at the long-term charts. When we broke that level, that 786, that told us that we are looking at a lot lower levels. But the market is incredibly oversold in the gold and silver. This market is an outlier event. I think it's down 10 days in a row, which means you could get a pretty good rally from any spot. But I believe the rally would be a selling opportunity, because we have broken major support in all of these, and that's these markets follow it very closely. So when it does that, it usually tells us that we're looking at something much more sinister that's out there. If you have any questions, it's 877-927-6648. Didn't get many calls today, so it lets me preamble on the things that are near and dear to my heart. But this is a critical time, folks. I really think we're going to start to see volatility increase. And the reason why I say that is we've had very little volatility in the stock market for a long time. The biggest move we've had is about 250 points. Those have been downsized moves. So, all of you do is you multiply 1.618 times 250. We're going to see a 400-point move. And beyond that, it's a 700-point move. And that's not really much coming from when the Dow was at 12,700. Volatility was in 1987, when the market would boost 4 or 5% in one day. So this is what we're getting ready to expect again. If in fact it does that, then we're going to make a few bucks. But someone asked me the best way to play this, and I think the best way to do it would be to do the SDS. And the reason for that is it's double weighted. You might as well get in and play with the big boys, do a little extra leverage because it's trading at a relatively cheap price at around $16. My gosh, if you go back and look at it, it's had a tremendous move to the downside. The old high back in August, just of August, was $28, and the high back in 2009 was $120. So it's gone from 120 to 17. So if it starts to move, you realize that it can go a long way and just make it can triple and only make a 3.82% retracement. Now, the other question that someone brought up as the devil's advocate, and I don't think it was a devil, I think someone made a very good point, is what if I'm totally wrong about this, and this is the greatest buying opportunity, across the world, at any one time? Well, that's possible, and we'll know that after, by the 1st of June for sure, because if the market's moving up strongly after the 1st of June, I am going to be wrong. I'm going to know that long before that, but that would be the latest. We've got a call from David in Denver. Are you there, David?
I'm here. Good,
what can I do for you, my friend?
Good to hear your voice again.
Oh, thank you.
You. Tell me, Larry, key bonds, if one has been long, is the date precedent at this juncture to still be at this point?
David, you're cutting out. Could you repeat that a bit, please? Because you are cutting out. I don't know if the rest of the folks can hear the static, but I'm not able to hear what you're saying. I think I've lost David. It was a very bad connection for some reason. Maybe he'll call back, but for some reason the connection was absolutely horrible. Well, we'll maybe he'll call back. He will call back, so we'll just wait and see what his question is. But believe me, this is not, to me, the problem with being in this business for so long is that you get a really feel for something. This is I really enjoy listening to Basil because he has a lot of experience, and when I listen to him talk from his his inner sanctum, from his gut, it really resonates with me because I know where he's coming from, and when he tells about these numbers, and we look at the same numbers because it's pretty easy to see the support that this is where the real players come in. But not many people were around in '87 that remember the crash and what it was like. And crashes don't happen very often. That's why I never use the C word very often. I like to use increased volatility, and we'll see if that works. But believe me, if you come in one day and the market is down 300 or 400 Dow points, that's probably not going to be a buying opportunity. Most probably, but it depends on a lot of different things. But we'll cross that bridge if we get to it. But the key to it is what we do today and tomorrow, and then what we do coming in on Friday. Friday is going to be such a key day because if we close really badly, my guess is just get on board, fasten your seatbelt, and let her rip. David, are you back?
I'm back. Sorry about that.
You have a good connection now. Go ahead. What can I help you with?
Question, Larry, on if one is long the bonds or short any of the metals or any of those kinds of things with the deeply oversold or overbought condition, how would you approach it? Would you just be inclined at this juncture to blow out of those at this point, or would you stay with them and just really tighten your stops down, tighter than your normal daily volatility?
I would tighten the stops down. The ideal situation, David, and not many people can do this, is just go on vacation. And don't even look at it. Just walk away and then come back. But if you're trading, I would tighten the stops down. If you'll stay with me, we'll take a little break, David, and we'll talk a little bit more about this. Okay?
Sure.
877-927-6648.
What you think about, you bring about. What you focus on grows. If you're committed to becoming an extraordinary trader and investor, then make mastery your outcome. Yes, my best student, Steve Rhodes, became my best teacher. But even more important is what he's taught me, and the time is now for you to take advantage of his knowledge.
Thanks, Tom. I've learned that it's not what we do once in a while that shapes our lives, but what we do consistently. I want to teach you the consistency that exists in the stock, futures, forex, and commodity markets day in, day out. For one solid day, Friday, May 18th, I'm going to conduct an online master trader course that'll teach you how to buy and sell the D point. This one pattern alone, with the single best entry and exit techniques, when combined with my money management strategies, will create extraordinary rewards for you and your family. The course will be archived so you can review it as many times as you'd like, and it'll teach you to become a master. All the details are on the homepage at tfnn.com. Sign up today because mastery is one click away. It's your decisions, not your conditions, that determine your destiny.
Wow! Go get him, folks.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. It's that time of year again, and the Great Panther Silver Summer Silver Giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of tfnn.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver Giveaway the whole month of June at tfnn.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
Okay, we're back. David, are you still there?
I'm still here. Yeah.
Okay, now I'll give you my 2 cents worth, and you get exactly what you pay for, 2 cents. But
okay.
Keep an eye on the U.S. dollar,
Right.
David. If we get above 81 in the U.S. dollar, we're about 80.70 right now. That would mean the euro would have to go below 128. As a matter of fact, watching the euro would be better than watching the dollar because that's 52%. But if we go below 128, like at 127.75, then I don't think we're going to get much of a rally at all. That it's pretty much ready to start the volatility, before I want it to happen. So that's my guess.
Yeah.
you know, you've been on the right side of it. You don't want to give too much of your money back, so just watch that. Any rally we get, you know, in the euro should stop at the 130 level. You know, be 150 pips from where it is now. If we do get that, and you know, it's all fitting together. You know what you're doing. You're watching the bonds. You know, you're watching the other thing. And if we do get this movement, and the bonds don't participate, you know, like today the bonds are participating pretty good with the down move in the market. But what if we get a down move in the market and the bonds also start to move down? See, people don't realize that they can go together. And you know, that's a main thing to keep an eye on.
Sure. And would you on these kinds of things like the bonds, would you be using a 382 from the last recent low back on the 10th, I think it was, or would you even tighten it up tighter than the 382 retracement?
No, 382 would be the place to do it. Yeah, I would tighten it up, for that. But I think that the time is so important here because the cycles that we're looking at something big is happening between the 15th and the 22nd of May. We've been talking about that for quite a while, and now we're in the window. So we'll see what happens. All the things are setting up the way we like to see. We just have to see how they unfold on Friday. It's going to be an interesting week.
Yeah. Okay, great. And second question, are you thinking that we'll get, are you looking for a bounce with some of these commodities to the extent that the equities may bounce? Or do you think that's going to be a tough
I try to look at them separately, but if the corn is incredibly oversold, soybeans are oversold, wheat oversold, cattle's oversold, everything's oversold. The question is, are we going to get a bounce? And in 2007 we didn't. 2008 we did not get a bounce. Everything just went straight down.
Yeah.
And crude oil has already told us. It smashed through 96. That was the last level. Last $96 a barrel. It did that on Friday, and so that's telling us it wants to go. Gasoline is already 10% off the butterfly top that we made 5 weeks ago. So everything looks down. The question is, like I say, David, the best thing to do is go on vacation and come back around June 15th.
Yeah, that's right. Okay, well, good to have you back and hear your voice, and hope you had a good trip, and we'll be in touch.
Okay, thank you very much for calling in, David.
You bet.
You bet. One of the callers talked about silver, and we mentioned the silver several times last week, that the importance of the 2860 level in silver. We went smashing through that. We're trading 30 cents below it right now. This is another situation where it held for several days. It looked like this is the 13th day in a row that it's been down. Now, Tom DeMark has a thing called, I don't know what it's called exactly. It has to do with a 13-day move, but anything after 8 days is an outlier event. So 8, 9, 10, 11, 12, 13. We're in the 13th down day in silver, but you could go to 18, you could go to 20. The all-time record in commodities for a move is 22 days up and 22 days down. The record is held by two commodities, silver and sugar. Both of them have done that several times, but we're 13 days down. We might break the record. Maybe it'll go 23 days down. We don't know. You're below the 786. I see no reason to buy silver. Anyway, everybody have a good day, and we will keep in touch, and may God bless. And don't buy any of the new coins, because they don't say, "In God we trust," and we have to trust in her.